So let me start with a hypothetical. We have a week in which we have COVID-19 increasing in infection pretty substantially in the United States. We have no stimulus bill, once again, and a fair amount of chaos in politics. And what does the market do? Well, the S&P is up 4 days out of 5, 2 weeks in a row, and the best since July. What's going on?
In fact, it's a similar question to what you had asked when I was last on Bloomberg with you in mid-July. At the end of the day, the market does trade to fundamentals, meaning people look forward and say, what are U.S. companies doing? What kind of growth can we look forward to past the acute phase of this pandemic? What do we see in terms of innovation and creativity and the resilience of American companies? And with that as the backdrop, then the general sense is that we're going to get reasonable earnings. Even without a stimulus bill, our base case is that the fourth quarter growth will be around 3 to 4%. For next year, including what we're talking about in terms of additional infections, we're expecting growth rate for 2021, let's say around 5 to 6%. And so that's going to be very supportive of earnings. We're expecting a slow but continued decline in the unemployment rate, and that'll be good for consumption. We've already seen a big turn in a lot of the economic indicators, right, from the trough that we saw in April to where we are today across retail sales, home sales. We're looking at mortgage applications, looking at new orders in the ISM index. So all the indicators point towards growth, even though when we look at the high-frequency data, we are seeing a bit of stall in the data. So we expect the uncertainty of the stimulus, which my colleagues in Washington have referred to as getting a bit of a whiplash, where one day we are getting a stimulus, another day we're not. And the market isn't always reacting in exactly the way we would expect to the news, but still some interim volatility. But even if we don't get a fiscal package now, we'll certainly get something in early 2021. And I think the market is beginning to look beyond that, but recognize we're probably going to have some volatility around the days of the election and possibly for another week after that.
Well, and I dare say some days this week we had the whiplash even within a given day, maybe more than once in a given day. It went back on and again, off again, on again, off again. But I respect everything you say. It makes perfect sense. Why are you on the other side of this trade from the chair of the Federal Reserve? Because we had Jay Powell come out this week and say, we need that stimulus. The error would be not having it rather than having too much.
Well, if you think of the risks, there's a lot of asymmetry to the risk that exists in the marketplace right now in terms of whether we're talking about the pace of infections. If we're talking about the unemployment level, is there more risk that things stall too much than actually things surprise substantially to the upside? So there's no doubt that any Fed chair would like to keep the balance and be supportive of growth given full employment is one of the primary mandates. So one can understand that they don't want monetary policy to be the only tool that is supporting this economy, and they don't want to risk seeing too much of a slowdown in case the infection rate is much higher and we see a little bit more sheltering in place than people are currently expecting.
Sharmin, you at Goldman Sachs recently had a virtual conference of some world-class experts on various topics, including Jason Furman, who used to be the chief economist at the White House. And one of the things he said was, okay, we're like 3/4 of the way back, but the rest of it's going to be a long, hard slog. Without special intervention like fiscal stimulus, are we going to be able to get there? Because the curve seems to be slowing down when it comes to things like, for example, jobless claims. Not as high as they were, but they're still over 800,000 this week.
Jason was actually very gracious, and he made a reference to all the work that Jan Hatzius, our chief economist, has done, and said that his expectation that we would get 50% of the way there and the remaining 50% would be a very long slog. And now he said he's been surprised that we are 75% of the way there and the remaining 25% would be a slog. So if you look at these two cases, everybody would rather have seen the 75% progress. And with the remaining 25%, it is the base case that it is going to be hard because some of the people who are, for example, furloughed may not get their jobs back, and getting retraining and finding different jobs will be a bit of an effort. So the base case is that we don't get to the 4% type unemployment numbers, 4.5%, before we actually get to 2023, for example. On the other hand, there is a lot more optimism in terms of the pandemic in terms of not necessarily what we might see going into the fall and winter season, but evidence that maybe the mitigation strategies that we have for the pandemic are working very well for the flu. So it's possible that the flu season won't be as bad as we saw in prior years, especially given what we've witnessed in the Southern Hemisphere in Latin America, or let's say Australia. In terms of the optimism on the various treatments and therapies, one of our guest speakers at this conference that you mentioned was Dr. Luciana Borio. She was former head of biodefense at the White House and acting chief scientist at the Food and Drug Administration. And she expressed a lot of optimism in terms of these therapies that we hear about from Regeneron and from Eli Lilly. Right. And they've both applied for emergency use authorization. Similarly, on vaccines, Dr. Hatchett from CEPI, an organization that has been at the epicenter of vaccine development, production, distribution, access on a global basis, also was cautiously optimistic about having some vaccine that would actually bring this pandemic, the acute phase of the pandemic, under control in the first half of next year. So when we look at these numbers, I think there's reason the marketplace is optimistic and overcoming some of the bearish sentiment of individual investors.
So, Sharmin, just briefly here at the end, I don't want to be pessimistic at all, but is the market pricing in the possibility of increased taxes if a President Biden actually gets elected as a practical matter, or is the market so strong it's going to blow past whether it's Trump or Biden?
There are two factors that I think investors are looking at when they're thinking about which candidate will win. One is, if you look at the long-term earning growth trajectory of U.S. equities, the long-term growth trajectory is about 6% earnings. And it happens whether we have a Democratic administration, a Republican administration, divided government, or a single party across the government. So that's one factor in the back of people's mind. The second expectation is that the fiscal stimulus under the Biden administration will be substantially greater and early on, and the taxes will be implemented later on. So that's going to be good for the economy.